Welcome to the Ideal Investor Show. Join us on the journey to financial success. Let's go. In light of the year coming to an end, but also in light of the fact that there is actually now movement, talk a little bit about what are the market opportunities and what's happening with interest rates. So the way I can report is, as you know, I'm originally from Germany. I'm closely connected to Europe, and so I'm always keeping an eye on the European market, also keeping an eye on other markets, but Europe is obviously one of the focus areas, and then the US is. So yesterday, when I'm recording this in the middle of December, I can say yesterday the European Central Bank has lowered their interest rates another 0.25%. So their interest rates, similar to what we are familiar with in the US, is now 3%. So just for reference, one of the aspects in this context is that the current level in the United States is 4.75%. And pretty much everybody is expecting that the Federal Reserve, or what's called the Federal Open Market Committee, in their last meeting for 2024 on the 17th of December and 18th of December, that after that meeting, they will most likely also lower the rate by 0.25%. So that would take it from 4.75 to 4.5. Now, always have to keep in mind, especially for anybody considering residential real estate investments in the United States, when you hear 4.5, that is not the rate that you're actually going to be able to get. For two reasons. Number one, if the banks were to pay 4.5% to get money from the federal government or from the Federal Reserve, they wouldn't make no money if they just gave it to you for the exact same rate. If you really think about how do banks make money is by the difference between how much do they pay to bring in money and how much do they charge you to sell you, so to speak, the money by giving you a credit or a loan or, for example, a mortgage. So normally they try to get somewhere in the area of 2%, right? So they buy for, let's say, 4.5, and then their mortgage would be 6.5. On top of that, if you want to get a mortgage for a property that you're not moving into yourself, so an investment property like we're always talking about, you need to add another percent. So that takes it to somewhere between 7.5%, maybe 7.25%. And then there are always a few organizations who try to be a little bit better, who might say, okay, we give it to you for like 7.1%. But just be aware from what you hear in the media that the rate may be going down to 4.5%. You have to add 2 to 3% on top of that for what you can expect to get for a mortgage interest rate. And then also, we all know it also depends a little bit on your credit score. So the lower your credit score, the more so-called points you have to add to ultimately get approved for the mortgage. Now, the other thing, and I've mentioned this before, is that in reality, we never really actually get a mortgage based on the Federal Reserve rate. We get the mortgage which is based on the Treasury bill rate. And what does that mean is the government is using and spending more money than they bring in from taxes. So they have to basically borrow money and issue treasury bills or treasury notes. And anybody, individuals and organizations, but also other countries, they can buy these treasury bills. This number, 4.5%, is not necessarily always exactly the same number as what the treasury bills cost. Right now, the treasury bills are between 4.25% and 5%. And that's really where you need to add your 2.5% to 3% on top of. Why is the rate not exactly the same? Well, think about it. The United States currently has more than $36 trillion in debt. And so everybody has to ask themselves, will the country be capable and able to keep paying back this debt? We are now looking at significantly more than $1 trillion every year just in interest that the government has to come up with. And if you think about it, they only bring in about 6 trillion. So 1/6 of every penny that they bring in, they have to pay an interest rate for the existing debt. Right, so that's obviously an issue. Now, the question is, and that's what I opened up with and what the title is, what are the implications for our real estate investments? Like many things, there's always a balance, or there's kind of like two sides of a coin. The one side of the coin is as the Federal Reserve is lowering interest rates, as the European Union Central Bank is lowering interest rates, and some other places are lowering interest rates, money is getting cheaper, and the cheaper the money, the better it is for real estate. On the other hand, for 2025, what's going to happen next year, I'm reasonably optimistic that we will see interest rates with a 3 in the front, and I'm pretty optimistic that we will see mortgage interest rates with a 5 in the front. And if we have another episode like this in a year from now, end of 2025, maybe, if we're lucky, we might see a few mortgage interest rates with a 4 at the beginning, like a 4.9 or 4.85 or something like that. But I'm definitely expecting mortgage rates to be coming down to a number around 5. Now, that is going to also depend a lot on what is economically going to happen, right? Because if some of the things that the new administration has announced are actually going to happen, this can have good or negative impacts on the economy. And depending on how well the economy is going and how well the labor market is going, how many people are unemployed, how is inflation going, all these things influence if the Fed is going to continue to lower rates or not. The other thing is, if we can't find a way, at least for the United States, to stop making new debt, basically adding more to the 36 trillion that we already have, that will also mean that these treasury bills that are really the anchor point for the mortgages, they will continue to be expensive, because the higher the debt level already is, the more people want to get in interest to buy any more further debt. So those things should be kept in mind. Now, how is the impact for the real estate market, our segment in the residential sector? Any little bit that helps to bring the mortgage interest rate down means that more and more people might consider to put their properties up for sale because they want to move into something different, something newer, something bigger. On the other hand, we also have to keep in mind whether the rates are a quarter or half or even 0.75% higher or lower, the impact on the monthly payment is not so big. We have to actually get down to numbers that start with a 4 or maybe low 5s before people will say, okay, this is a monthly payment that I can see that I pay. I'm cautiously optimistic, but I would also not be surprised if any kind of new rally in residential real estate will be delayed towards the end of next year, at the end of 2025, rather than start when normally the new selling season starts in the spring. And the only reason is just because people that are not making so much more money in their wages, and monthly payments, if you go from like a 2 or 3% interest rate to a 5, is just still too much for most people. That's also, if we summarize 2024 overall, the residential real estate market has been very, very dormant, almost like a dead market, just because people didn't move, right? The people that have properties with low mortgage rates didn't want to put them up because anything they looked at was too expensive in their monthly payments. And anybody who wanted to get out of an apartment or a student dormitory or so, considering buying, found out, well, if I buy something, the monthly rate, even if I qualify, is so expensive that I'm better off staying where I am, or I stay with my parents, or I stay in the apartment or something like that. So that's the situation, cautiously optimistic, but a few things have to happen in 2025 to really get something going. And that's also a cautionary tale for anybody listening to this episode from an investor perspective. Right now, we as investors have the market pretty much to ourselves. We are the only ones who actually buy properties if they pencil out. As soon as rates keep coming down significantly enough so that more and more people say, I can now get a new house for myself, not brand new, but another house, I should say, then we are back into competition with these people. And one thing I'm predicting is when the rally starts, whether that's middle of next year, end of next year, or maybe in 2026, but when it starts, prices will probably go up like crazy very quickly because there will be so much demand. So that's it for today. Be well and stay safe, and wish you a good holiday season, and we talk again tomorrow.